Welcome to Introduction to Accounting, Preparing for a User's Perspective. Compute and understand the return on sales ratio. The return on sales ratio is a measure of a company's efficiency, and it is computed as follows. Earnings before interest and taxes divided by net sales, where earnings before interest and taxes is your net income, then you add back interest expense and add back income tax expense, earnings before interest and taxes. Net sales is your gross sales less sales returns and allowances, which represents the sales prices of the items that customers have returned for whatever reason. Less sales discounts, which represents the amount of discount given to customers who paid off their account early, equals net sales. The sales figure that many companies report is usually their net sales figure, so you will not normally see the full computation of net sales on the face of their income statement. Return on sales is also referred to as operating margin, operating income margin, and operating profit margin. It tries to highlight how much income a company is able to generate out of each dollar of sales after considering the related costs of operating the business. The return on sales ratio is an indicator of a company's efficiency because by dividing the company's earnings, EBIT, by its sales, net sales, you obtain a ratio that indicates the amount of earnings, EBIT, the company is able to generate out of each dollar of sales, net sales. Therefore, if the return on sales ratio declines, the company is becoming less efficient and less able to pay bills, service debt, pay dividends, and increase shareholder value. If the ROS increases, it is becoming more efficient and is more able to pay its bills, service debt, pay dividends, and increase shareholder value. Users often compute a company's ROS for multiple periods of time to assess whether the company is becoming more or less efficient. Why don't we have you assess ABC Company's efficiency by using its income statement below by computing its return on sales for each year 20x1 to 20x3 and determining whether it is becoming more or less efficient. Please stop this video now, make your computations, and perform your trend evaluation. Then start the video again for further discussion. Here are the detailed return on sales computations for 20x1 to 20x3, rounded to the nearest two decimals. As you can see, for 20x1 we took net income, we added back interest expense, added back the income taxes to get that total earnings before interest and taxes, divided it by the net sales revenue for the year to get a 0.58. We got 0.61 for 20x1 and 0.63 for 20x3. In summary form, here are their return on sales ratios. Based on ABC's income statement and its return on sales ratios here, it appears that not only is ABC generating more net income, but it is also becoming more efficient because it is generating more earnings before income and taxes out of each dollar of sales, increasing from only 0.58 cents out of every sales dollar up to 63 cents from every dollar. Please make sure that you learn how to compute and interpret the return on sales ratio. Good luck on the quiz.